We went from 2 years ago, I only want green, that's the only thing I'm going to touch, to I need everything as soon as possible, for a long time, and to y'all's point, reliable.
Okay, boom. I think we're live here. So we got a little repeat episode this time. Nader has come back, but he's brought a friend, a colleague, someone who might, quite frankly, probably going to steal the show relatively today. And I'm very excited because while we've sort of been doing what we're doing, they are now approaching their third iteration of their strategy on asset management. And why I want to brag on them so much before they get going is that this looks to me like what a new generation of energy asset management is going to look like. If you want growth capital and you want to be an emerging GP, these are the two people I always recommend sort of following in the footsteps of. The world's going to look a little different than it did 20 or 30 years ago if you wanted to be an emerging GP. And today, I think we're going to cover a lot of their learnings, lessons, and what they're doing next.
Thank you, Raj. Good to be here.
Yeah, yes. Thanks for having us, Raj.
You guys want to get into, look, we're going to step on each other's toes because normally we do the episodes like one-on-one. And now we've got, 3 folks and we all like to chat, maybe not or a little less. So how about we get going on a little bit of a kind of 1-minute intro on how you guys came together, what the thesis and the story is, what you guys have been working on so far, what you guys are excited about.
Sure. Let me kick it off and I'll hand it over to Nader. But coming from a team that, sort of walked out of the Landman episode, not out of a fancy Menlo Park office here. And, our motto is, we suffer together. I like all these American things. Yay, let's have fun. And, first is let's have fun and then other things. And we hustle, we suffer together. And I know this sounds basic, but we actually take our investors and a duty to our investors incredibly, seriously. Those are people that we've known for a long time, and we are hopefully offering them something as different. And we'll dive more into it in detail. But Nader can talk about how we came together and how our strategy evolved.
Yeah, no, for sure. I think, and also, Raj, to your point on, next generation asset managers are dedicating their time towards energy. I also think we're at a stage from an industry perspective and from a EQ perspective where being boxed into one siloed subsector, might not be the best proposition for, the LP investor base, right? We have a flexible mandate. We come from diverse backgrounds, covering both oil and gas, upstream, midstream, but also a lot more on the power side, distributed power, and then more recently on the digital asset infrastructure side. But being in the flow in the capacity that we are, and effectively raising capital on a deal by deal basis allows us to be very flexible, right? We're in the flow. We see things that otherwise you wouldn't see if you're just focusing on one niche, right? Within energy or within industrials or within power. That's interesting, right? I think the age of independent sponsors at a time where AUM is, AUM growth is diminishing, right? If you look at the last couple of years, rates are higher, money's harder to get, et cetera. Money generally has gone to the incumbents. So you're seeing kind of new strategies come out. We're one of them. But we think the independent sponsor model, with some level of capital commitments allows for a really interesting proposition that LPs wouldn't necessarily get, just going down the traditional route. But Chase, taking a step back, Andrejka and I mean, we go way back. We were in the bullpen together back at 600 Travis. Forget what floor it was. Maybe Andrejka, you remember, but
I don't want to remember, probably.
Yeah. Yeah, we go way back when I was an analyst and Andrejka was an associate. So MLP boom times was when it all started, and then we went our separate paths. I went more on the upstream side. A couple of portcos backed by PE firms. She went more on the midstream side. And, we relinked up again, probably in 2021 after she kicked off the SGen platform. That obviously, that's where we spoke a lot of our time last episode, Raj. And it's been, it's been paradise ever since.
Well, it's good. Andrejka has been described to me by multiple people as hardcore. One of the most hardcore people they've ever met. This is obviously in a very, very positive way. She's smiling. and that there are literally like, sort of boomer men that I've met that have said I would not want to sit across the table from her. It's so scary. So that those are the two sort of insights that I got before we ever met, but I haven't seen it yet. So we're going to find out in this call if it gets a little too aggressive or not.
You must have talked to my kids, Raj. Those were probably your sources, I think.
No,
But
no, some other
aside,
analysts and some other folks on the management teams historically, but like it speaks to you guys' culture, right? You guys are aggressive and hustling quite hard. I think we talked about it at one point. It's got to be, at least at this point, thousands of investors and thousands of management teams that you guys have looked at.
Yeah, those are probably right figures, Raj. And I would say our backgrounds are similar in some ways with Nader and the rest of the team. Is came from nothing, right? So you don't kind of. I actually tell my kids that the luckiest thing that ever happened to me in my life is that I was born poor, because there's no way I would get to where I got, with kind of sort of wealth of things. So, but I think it's what it translates into from our investment approach and strategy is what connects our team and what connects our personalities is we are operationally focused, right? So when you actually think about the GP dynamics in heading into the next, call it 5 to 10 years, one thing we have discovered, Raj, from the hundreds and probably thousands of companies that we've and management teams that we have to is the world is evolving quickly, whether we want it or not, right? So we either embrace it or we get into a hole and ignore it, right? And that's probably not a good outcome. So we decided to go with the first option, essentially. And well, I know we'll talk about AI and crypto and other things, but when you think about AI, and obviously there are a lot of skeptics and etc., but there is a new addiction, and I will blame Nader for my own addiction in terms of AI addiction. So he introduced me to Chat GPT, and I cannot, imagine a day without it. And that's just a Chat GPT, right? You have a ton of other AI agents that you can really use to transform your life. So if I, at the age of 45, am addicted already, just visualize the generations below us. So the world is changing. You need new energy sources. You need them in different places. You need them at a different pace. And so what's then translates into our investment strategy and approach is that also requires a hands-on approach with management teams. So we are operators. We know how hard it is to get a commercial contract. We know how hard it is to get a slug of debt. We know how hard it is to apply, get a process or accounting system in place, etc. So I think what's really required as the next era of investing in energy and infrastructure and industries feeding the AI growth is really a sort of more of a hands-on approach and more of a partnership with teams rather than, hey, Raj, nice company. I'll give you $100 million, check in every quarter, and then I'll hire a bank to sell you in 5 years. Much more of a partnership approach is necessary in the next sort of series of energy, similar to what we saw at the beginning of shale boom.
Yeah, and I think to that point too, I mean, we're obviously very lean, right? I mean, the ability to, cover a large portfolio, that's not going to be our, our focus, especially today. Our approach is much more around, to Andrejka's point, super hands-on, and by hands-on meaning being in the office, right, for at least the first 6 to potentially 18 months, whether it's a reorg or a distress situation, or whether it's more of repivoting the business plan. But our kind of focus on concentrated investments, right? Control-oriented, concentrated investments where we'll have an investment compass, but really we're looking at everything through an operational lens because we came from that ilk, right? Being backed through multiple cycles, ups and downs, couple iterations, right? In total, probably between Andrejka and I, at least, 5 or 6, all different sponsors, right? So different flavors. And there's a lot that goes with that with management teams that we speak to, just because there's a lot more to connect with, right? Versus, Andrejka joked about Menlo Park, but I mean, whether you're a Midtown Manhattan office building, and you're coming out and saying, hey, we want to be partners and we're like-minded and we want to be there with you, etc. Versus our approach, it's no doubt that it's different, right? Which one is more effective is going to be the test of time the next 3 to 5 years, but concentrated, super hands-on, operational viewpoint, and obviously being able to connect because we were in their shoes. I think it's definitely a differentiation that we tried to pride ourselves on.
And what Nader, I would add to that. I mean, what Nader means by concentrated also means high conviction, right? I mean, there is a formula. I mean, obviously, market is one thing. So if market totally turns against you, there's really nothing you can do except for completely reposition the business, which is possible as well. So, but generally, there is a playbook that you can play out in a very systematic manner if of building a business, right? Whether it's consumer products or whether it's in our energy industry, but very few people sort of diligently, systematically follow that playbook. So high conviction investments at scale that you just apply a really diligent and very systematic execution around that.
That makes it makes sense. I mean, like the things that stand out to me on what you guys sort of did. One is, as Nader was talking, is like the traditional cycle is you get a lot of capital committed, and then that gets drawn over 10 or 12 years on a very tight box mandate, right? That's like traditional private equity structure. You guys have a very different structure, and obviously it's a very opportunistic, is probably the way I would characterize it, deal, which is, there are market cycles where things are certainly more interesting or not to get in and out of. And you probably have a little bit more of that flexibility where it's really tough to say, do you like this strategy and do you want to invest in that, in year 6 from now on raising a fund? It's really tough to tell, right? Like, really tough to tell what the world looks like 3 years from now. So you have this sort of opportunistic pool of capital. Adjacent to that, because you're an emerging manager and you don't have the legacy brand of just getting deal flow sent to you because you've been in the deal business for 20 years, you kind of have to hustle quite aggressively. But by hustling aggressively, you build your own culture, right? Which is like, like the fact that I know that Andrejka is hardcore probably is, I'm not the only one who believes that to be true, right? Like there's probably a lot of people who have heard, okay, these guys are hustling. They're looking at a lot of things. Maybe I should visit with them if that resonates with me culturally, and that fits really well. And then, the next point for me is I subscribe very similarly to your approach of business development, which is there's a power law to meetings, which is, this year you guys are going to have hundreds of meetings, but 1 or 2 of them will be more valuable than the sum total of all of them. The problem is you just don't know which ones they are. So you sort of have to say yes, unfortunately, to all of them and have the attitude that you treat all of these similarly. You guys are going to hop off of this call and go on to the next one. And objectively on paper, maybe it's important, maybe it's not, but you really don't know unless you have the attitude of having all of them all the time and being diligent about that. So, that much I appreciate. Moving away a little bit from, sort of the culture and the asset management structure, you guys did a crypto SPAC. It's sort of like, I think the number one statement that I've heard in the last couple of weeks. Maybe we should dive into that a little bit because it's completely orthogonal to everybody in oil and gas. So they're wondering what the hell you guys were thinking.
So I have to be honest. I mean, I knew almost nothing about crypto earlier this year, and really the only things that I knew about crypto were generally bad. And I knew that Jamie Dimon says crypto is not good, and he must be seeing everything in the world, so he must be right. So I just want to take a step back and share this with your listeners because I wouldn't be surprised if a lot of them probably come from the same perspective. And then we took a step back, and when we when we hustled this opportunity for our SPAC, that you're right, Raj, originally was we were looking at energy and infrastructure and power at adjacent industries, etc. But when you take a step back and you really kind of visualize the world where it's going to be, and you read a bunch of white papers, you really start kind of getting where this next phase of infrastructure is heading. So number one, I visualize. So I listened to the interview that Bill Gates did with David Letterman in 1995, right? And it's a really interesting interview because David says, well, Bill, we already have you have this platform that's exchange of information, it's sharing information, but have you not heard about radio or TV or we have newspapers and telephones. Like, how is that different from like what you are doing there? It actually sounds a little bit more complex than what we already have. So I would actually urge viewers to listen to that interview. And then there's another interview with Steve Jobs on one of those talk shows, and actually it was the Microsoft CEO after Bill Gates. I'm blanking on his name now, but anyways, and he does an interview and he's laughing about Steve Jobs, saying, who is going to want to have a phone like this that costs you $500? Nobody's going to buy that.
Right.
And I would actually say, for my personal life perspective, internet and iPhone or smartphones are probably the two biggest inventions, and fundamentally believe that the blockchain, crypto, digital asset space is sort of the next extension of that. So that was the first thing. And then and it's going to influence our lives, and Nader can go into details there, but our daily life is fundamentally likely to be transformed the same way it was transformed with internet and iPhone. So that's, I think, what people need to understand. It's not just a replacement of a dollar or a credit card. It's a fundamentally different way that you're going to live, whether it's in 5 years or 10 years, whatever. So that's number one. But number two, what was, really interesting in that time period when we were, assessing what opportunities we are going to target is the Genius Act came out. So government actually supporting from a regulatory perspective the ecosystem. And, all of a sudden, Jamie Dimon and JP Morgan has embraced,
of course,
the asset space. And so did BlackRock and Robinhood and Deutsche Bank and, many others. It's really a really important moment where we are seeing sort of customers coming in, commercial customers, retail customers, and obviously, investors as a consequence of that growth and also anticipated growth coming into the space. So, and then obviously, we wanted to partner with the right team. I wanted to, make sure that they're experienced, high quality, and they're able to build a large platform.
And they're bringing a lot of consideration to the table.
That's true.
That is true. Yes.
I have not seen more skin in the game than the deal that you guys just did.
The second, so, the founder, Andrew Keys, contributed $650 million of US dollar value of Ether. And the next largest investment in the space was $40 million.
Yeah.
I mean, orders of magnitude. So it shows an extremely high level of conviction. And it's not only conviction into, doing the deal and closing the deal, but continued alignment with public investors going forward. So our goal, Raj, with our last SPAC was very simple. We want to bring a high quality business to the market that's going to raise the capital it needs to be a scalable, large scale company to start off with, and is going to trade above trust level. We wanted to deliver value to our risk capital investor and our public investors, who some of them have been with us for the past 3 ventures, actually. Pretty simple formula.
And I think even like outside crypto digital assets, I mean, name me one founder who wasn't just rolling stock, right? Like an incremental new investment into their business at that stage of the game. That, I mean, it's fairly
it's already a liquid asset, right? It's a completely liquid asset. I mean, like when I read that, I was like, like the one sentence here is you're taking public a company in which someone is contributing, 99% of their net worth, but not just that. It's $650 million worth of an asset that is wholly liquid prior to the public deal, right? And so, like you really have to say, okay, it's something you really need to look at because the incentives are highly aligned, unlike most of what we don't really probably want to dog on too many, but like it's very much the opposite of what you generally see of people trying to do a de-SPAC transaction, right?
Yeah,
it's wholly different.
It goes back to the conviction point, right? It's you need to make investments that are high conviction investments.
So I have a very rudimentary understanding of digital assets and crypto. And I have a negligible amount. So if anyone wants to come try to steal my keys, feel free. It's my take here was always like, look, there's this entire ecosystem of digital assets, and this was maybe 6 years ago when I made this sort of bet or a small series of bets, and so you have this new asset class, And the view is every day someone who owns that asset class is telling someone else, hey, this is how I got into it. This was my reason why. Maybe you should get into it. And so like my very like Neanderthal brain is just like, well, you have this asset class. Some of it is finite depending on which currency you're in. But like, just think about it broadly as Bitcoin, Ethereum, or something like that. And day over day, there will be more people who participate in that market. That's like just the root of the high level view that I have, which is, so if you sort of take a 10-year time horizon, there's way more people who own some version of that asset class than they did, 10 years prior. And so if that's true, just get in is like the view. But get into an amount where, for me personally, it was, this is an amount where if you lose all of it, less relevant to me. And the reason why was if I put too much in and it rallied, then I would feel like I have something to lose. And I know myself enough to know if I feel like I have something to lose, then I trade out, which is now antithetical to the thesis I just described, which is I have to have a very long-term viewpoint that there's a new asset class and people will be involved, and the younger people are always more interested. And so, like, so long as the demographics play the way they do, then you have this. Now, that thesis like sort of trumps everything else in my mind. So whenever someone's like, oh, well, there's this protocol that does this, there's this, like, all of those are nuances to this original thesis that is still true, right? Which is there will be more participants in this market on a long enough time horizon. So make your bet now, right? Like if you sort of can look in a crystal ball and say there will be way more people involved in this market 10 or 20 years from now, then just get in now. That's it. That was my rudimentary view.
Yeah, I think also,
Nader, if we maybe talk about Bitcoin versus Ether, that could be interesting for your viewers, just the fundamental differences between those two.
yeah, I mean, I think, listen, at a high level, I'll make one comment too. Like why we did, why we focused on this sector in the way that we did. Quite frankly, me personally getting into energy, right? I think in 2010 was by nature of that was the high growth industry, right? I graduated from. I didn't go to high school to go become an upstream or an oil and gas guy.
There was
It was
capex and growth there, right?
It was the financial crisis, right? Where were their seats? Where was their growth? And if you look at sectors that grew from zero to, or let's say near zero to multi-trillion in terms of market size, whether you define that by market cap or annual sales or however you want to do it. I mean, if you go through, and Andrejka talked about one of them, smartphones, right? It was zero. Look at the market cap of now every company that sells smartphones. If you look at cloud computing, data centers, we know that story, from zero to however many trillions today. You look at e-commerce, scale was that. Happened to be from Houston, the network is there, and the ecosystem was there. Fast forwarding to 2021, the reason why we focused on energy transition and so did so many others was for similar reasons, right? The question is, which of these can actually evolve into long-standing, durable businesses where very basic, right? The unit economics work on a pre-subsidy basis, right? And that's the name of the game. And if you can be a part of that cycle, whether you're on the public or private side, clearly the math works, right? I think for us, crypto also encompasses that exact theme, right? If you look at the market value of every crypto coin today, it's probably nearing $4 trillion, right? Of which more than half of that's Bitcoin. Ethereum is roughly a 550 billion market cap. That's just the intrinsic value of coins. If you look at ancillary businesses on top of that, stable coins, DeFi, Web3, all of that, it's probably another $500 billion today. And if you look at and believe whether it's Goldman forecast, Fidelity forecast, Barclays, or now this administration, and look at the growth of stable coins and that entire economy, DeFi more broadly, right? And just the velocity of payments and financial transactions, whether it's your Lyft Uber ride, whether it's United plane ticket, whether it's a way that your employment agreement's going to get paid out if you're at a large company like Google. It's in our view, it's a no-brainer in terms of what the trajectory will look like for the next 5 years in terms of growth, right? And then it's well, where does it make sense for us to spend our time, which is obviously how the ETH machine deal and specifically, Ethereum became super interesting because not only, is it a store of value, right? Bitcoin being digital gold, Everyone's heard that analogy, a million times. Ethereum is really, a giant computer, right? That's everyone in the world can use at the same time. And on that computer, you can set up various archetypes that can do stuff, right? Smart contracts that'll have kind of if then else statements. You can build in stuff, right? Imagine stuff that you can download on an app store on your iPhone. You can say, hey, I want to do a 1031 real estate exchange on Ethereum. Can't do that today. It's probably going to happen in the next 5-10 years. I want to send $10 million under 3 minutes with a super low fee. You can do that on Ethereum. But there's so much, I'd say, so many permissions and so many new concepts you can invent, almost like Legos, I'd say, on that blockchain. That the best analogy that Andrejka that said earlier is like the internet, right? So Ethereum for us, it's different in the sense that it's a productive asset, and it's much more like oil or gas in that sense, right? You can actually buy a commodity. There's volatility with that commodity. There's a use case and productive nature of that commodity. ETH machine is like buying an upstream business, for lack of a better word. You can either buy oil or you can go buy Permian Resources, right? Most folks are pretty opinionated on which one is the better play. And typically producers are going to be able to optimize, right, based on their unit economics in a better way and offer that in a risk-adjusted way for investors. And that's effectively what this transaction is trying to,
Yeah, I get the summary as well, which is like, Bitcoin versus ETH. Again, very, very primal sort of like view on this is like one is a store of value. One is in that store of value also means it's somewhat of an unproductive asset. Like gold, gold bars is somewhat of an unproductive asset. You can make the same analogy with Bitcoin. It's digital gold. ETH, on the other hand, feels like it's a productive asset. Now, that comes with its own set of challenges or why you may have volatility or whatever the case is, but it's a productive asset at its very core, which is very different than just purely a block of gold. It was my take to have any sort of allocation there. And most people who get involved in cryptocurrency probably start with just Bitcoin, and then they sort of go down the gambit of a few of the others that are all some version of the productive asset. But ETH feels like the Park Avenue of productive assets on the spectrum of that so far.
Yeah, and I think Raj. I mean, I'm coming into the space with very extreme limited knowledge, right? So I'm trying to wrap my head around that, those concepts. The interest, the eye-opening moment for me personally was, Bitcoin, like you said, store of value. The way you have to think about, the entire digital asset universe is it's not just transactions, right? It's bilateral contracts. It's store of your entire information. I'm going to go to a doctor. It's going to have all the information, and they're going to say, I'm going to XYZ doctor. I want to just pick out this information, give that to him, And then, by the way, if this happens, then do that. So it's not a currency almost. It's a way of living in a series of all these very unique contracts that you live your daily life. Where I think that a lot of folks don't understand that component. It's just, you don't even realize that your day in life of, Raj Mistry is basically, 1,500 of different contracts that you are, leading on a daily basis that you can now, really sort of streamline. And, transactional value is piece of it, but there are many other components.
Right.
And the other thing, the easiest way to think about it, too, in my opinion, Raj, is like, what's the value of intermediation, right? Why does a JP Morgan or a Bank of America exist, and why is the market caps the way they are? There's clearly a way to define tangibly that value, right? Sending money between two people and having a bank in between clearly is worth multi-trillion dollars. There is, imagine going back to my computer example, right? A rule book that typically can't be changed unless, in Ethereum's case, there's a protocol and there's more detail around that. But there's no 1-800 call Ethereum, right? Or 1-800 call Bitcoin. There's no one to call, right? There is like Monopoly. There's a game, there's rules. You have to play by the rules. And as long as you do, the system works, right? And if you don't, then you actually are slashed and you're excluded from that playing that game on a go-forward basis. That same concept applies to the Bitcoin miner that's solving puzzles, right? In West Texas at a data center that's doing that, or with Ethereum, which is not doing any of that, right? And it's a different proof of stake versus proof of work complex. But I think it's a really good analogy that makes sense to me is, what's the value of not having a middleman, right? And if that middleman historically was, your commercial bank. Why are they embracing it? Maybe because there's a threat, right? And this administration clearly has, with the Genius Act, has put that on front and center, right, on everyone's radar. And then the same thing goes for merchants, right, and vendor. Any payments that are being transacted, typically you're paying, somewhere between 2 to 5% to a Visa or an Amex, right? Stable coins clearly put a big risk to that market, right? Because you can send billions in seconds with almost negligible fees, right? And it's struck to a code that works and everyone trusts. There hasn't been 1 minute of downtime on Ethereum since its inception. So all of that's other ways to think about why is it worth what it's worth. That's the part that's tough for why is it worth 4,000 per token or 100,000 per token. Those are the items that I think are helpful to think about.
I actually think there's a bull case more aggressive than what you just described, which, not sure I will express a trade that way, but I think the bull case here is actually greater than the financial sort of system. So I think here's a good analogy that I think Bill Gurley probably talked about, I think, when they first invested in Uber, which is, Andrejka in talking about the internet is the same thing. When you 10x a historical market, the viewpoint is you just kind of take market share from that market. But the reality is what happens is you sort of open up a new market that is maybe 10 to 100 times bigger than the old market. And you are sort of the new incumbent in this completely different market. And so if you sort of size the value of Uber today and said, oh, Uber is going to 100% take over the taxi market. The taxi market, they've surpassed that and some today, right? Because what Uber did was it opened up a completely new set of businesses. Now I can get my burrito delivered. I have all these new use cases. It replaced people having to rent a car. It replaced people even having to own a car. It created a gig economy of workforce. And so all these sorts of things that really didn't get contemplated when the original business plan is we're just going to 10x the taxi opportunity. And so the same thing I think is true here, which is oh, we're going to 10x gold with Bitcoin, right? Here are the reasons why it's better. Okay, Ethereum, we're going to 10x traditional currency and payment structures and transactions and contracts because of this. It's yeah, but we're sort of underestimating the number of use cases that get opened up because of that. And that is actually very different than how we currently value the financial system today. And so I think that's the ultra bull case, if you will.
It's a really important point, Raj. It is, the same way, again, going back to 1995, it was impossible except for, a few people to visualize a completely different information world, right? With the internet. The same way the digital assets is visualize digital assets, enabling a completely different world from a trust perspective, right? We are taking trust, which is transactions, contracts, any bilateral sort of thing. So that is it is a market that has never been here, that is very hard to visualize. And so I would even say that I don't know if the Uber example is a good one, because you can sort of forecast from that changed industry that's sort of already there and just replacing it. This is actually creating a completely new industry from, and taking trust to a level that we have not seen before, just like we did with information in 1990s.
Right. Yeah. And the same could be true with the same will be true, in my opinion, with AI. Right. So, right now people are oh, AI comes and takes your job. Sort of the threat. An analogy I think about a lot is a data center today will produce more intelligence and knowledge work than a standard office building in Manhattan, full of Ivy League educated, people who are working, 7 days a week. It doesn't matter. The total output out of a data center will be more intelligence knowledge work, which is kind of a crazy thought process. But if you create that enabling technology, what does that mean? That means we do work that you otherwise wouldn't. So you sort of size up the labor market today, or you size up the software market today. I think the view at one point was cloud is going to replace on-prem software and it'll just be the same market size. No, 100x the software size, right? And so if you have AI now, it's oh, AI might eat traditional software. It's yeah, it might be 100x the current software market. We don't know for sure, but like it could potentially enable 100x, right? Like, which is why, like to me, AI is sort of this infinite market. Adjacent to that, chips are clearly an infinite market, but that also means power is an infinite market, right? Like power is the new labor here, right? Like power plus chips is the new form of knowledge, work, and intelligence and labor. And so, like that comes thematically to the thing that I think everyone in energy is probably most excited about today, right? Which is this intersection of power for a growth of sort of AI. Where is your pulse on what that looks like? Is, like, do you think the base case is bullish enough? Do you think it's too bullish? Do you think we should be bearish? Yeah. How do you feel about this thematically?
So from a personal perspective, again, I'm addicted to AI already. And so, we do think it's real. Who knows what the numbers are? I don't even pay attention to these mega numbers because that's beyond my personal, brain cell capability. But the truth is, it's here to stay because consumers want it and it's highly addictive. And the way we actually view AI from our day jobs and opportunities that we are looking at, Raj, is we call it the San Francisco coming to Houston phenomenon. Houston doesn't need San Francisco, but San Francisco needs Houston. And so the two layers that are, to your point, that actually enable growth of AI, it's not necessarily the AI technologies themselves, it's actually energy. And that is from wellhead or whatever is your source of energy, all the way to the infrastructure, all the way to power, all the way to distribution, et cetera, et cetera. And the other is obviously the trust layer. So energy and trust, and the trust layer is the digital assets. So if those two segments don't grow, AI will not grow, right? And so we are actually happen to be obviously involved in both of those arenas, but we're the opportunities in sort of the next phase of industrial evolution, which is AI evolution, are enormous. But we can talk about, and Nader can point out to how we are approaching the space, and how we feel it's also a little bit different than maybe from what the investment world saw before.
Right.
Yeah. I think also, it goes without saying, let's just be honest here. Like, AI is a savior to everyone that was kind of focusing on, upstream shale or midstream, moving that upstream shale. It's clearly been, it could not have been perfect, better timed, right? For an industry that's, for lack of a better term, is going through a long phase of an existential crisis, right? And AI has been the savior, right? Because if you just look at, I was reading this morning or yesterday that Oracle announcement in the journal. I think it said almost 5 gigawatts of power capacity, and it said it was comparable to 2 Hoover dams from a size perspective, right? So if you go through the amount of gas that's necessary, that's a lot of zeros. Just think about that incremental demand. That didn't exist in anyone's forecast in 2020 or 2019, right? It was generally LNG, which has been great in terms of growth, but this is, whether these turn on or not, that's TBD. Clearly, some will not. Hopefully, many will from a large scale project.
How much can the market really support, right? Because, to be honest, like we think a lot about the power side of this. The power is like 15% of the cost of these things. Like it is really the GPUs. It's like, how much money do you have to go buy chips from NVIDIA and put into a giant data center? And there's only so many shots on goal on that. Look at Meta, is this Oracle deal they just talked about. They're raising private alternative capital for that. Meta in Louisiana is publicly, getting Blue Owl and PIMCO involved. It's a $2 trillion business that just spits off cash. So one of the best, it is one of the greatest businesses ever made that spits off cash, and they're still tapping private markets. Like that should signal a lot of what's happening here, which is like these guys are going to tap out on credit. I think for now, until you get to that next phase of revenue growth from this as well. I think it's sort of the steel man argument on the other side of capital markets.
You can look at it. It's interesting because there are two ways, you generally look at any investment. It's macro and micro, right? So from a macro perspective, gigawatts and GPUs and all this, and you can get overwhelmed by all this enormous data. But what we see on the ground is actually, it's, again, energy, and your viewers are obviously very familiar with that. Energy, you can't invest 20 million into a software that spits out a $100 billion business, right? Energy is very capital intensive, technologically intensive. It requires regulatory component. It requires a ton of people. Somebody has to build it, somebody has to run it. And by the way, if we don't do it the right way, somebody's going to get hurt or die. I mean, this is very serious business. And so what we are seeing now on the ground, Raj, is again, the San Francisco coming to Houston thesis is great, gigawatts, wonderful, but somebody actually has to do the dirty job and build it and run it and do it right, and use and do it quickly as well. This is not like hey, build me something in the next 5 years at your leisure. I need it right now, because
and
that high
near-term
school
grid is already spoken for, right?
Yeah. And so what we are seeing is actually, there's going to be an ecosystem of companies that, again, very similar to what happened in US shale growth. You kind of have to block and tackle. It's not like you have a ton of power companies that know what they are doing. And certainly from the hyperscaler perspective, this is infrastructure that's beyond what they've ever seen. And so, how do you think about contracts? How do you think about what are the capital sources? How do is there a consolidation of the space? Should we have 20 people doing the same thing, or having one person? And that's not easy to do either, right? And so there's just a lot of blocking and tackling that we think is going to take place over the next 5 to 10 years, so that we can create a company that Brookfield can buy, or Blackstone can buy, or Mubadala can buy. And so there's a lot of exciting work and a lot of translatable skill set, and frankly, a lot of scars that we learned from our business, how not to do things. Because, a lot of that infrastructure, again, is right now, it's housed in that kind of tech firms. But as we kind of, evolve here, you're not investing into Oracle thinking you're going to invest in a whole bunch of 12% earning infrastructure here, right? That's not why you invest in Google or Oracle or Nvidia. It's really at the scale of these infrastructure projects and services that are being provided is so large that you're going to have a whole host of new players coming to the space on the micro level, building companies 200 million, 300 million a piece, so that you can build a business that's actually high quality public or large infrastructure or private equity style business. That is what excites us the most about the space.
So if you play this theme today, right, let's say private equity fund gives you $100, $200 million commitment, what are the obvious or non-obvious areas that you think you spend a lot of time on thinking about? That obviously you really love this theme. You guys know that I'm really down the rabbit hole on this theme. How do you think about deploying that capital? What's most interesting?
Yeah, I mean, listen, I think, it's tough to answer, mainly because the obvious angles everyone's chasing, right? So whether it's, data center ancillary services, so like, switchgear, transformers, backup, HVAC, cooling, fiber, all of that, capital is not constrained there, and assets are bid up and multiples are expanded in a really elevated way, right? It's backed by growth, but you're paying for a lot of that in your purchase price. Then you go into, picks and shovels of the AI build out. That was a good idea 3 years ago. That's now difficult. You're thinking less about chips and more about all the more infrastructure related elements. So today it's tough because a lot of that hasn't played out in a way that's failed, to where those opportunities that were good business are now attractive. So that's led us to think a lot more around non-obvious angles. And again, we are opportunistic because we can be a super flexible mandate. I mean, my personal view is I think things around automation are very interesting. So it could be old school, SCADA telemetry back in, think 20, 30 years ago, and that was a new and innovative and cool thing. But, in the 2025 to 2030 version of that, right? So it could be automation for, predictive maintenance, robotics around downtime reduction for
just reducing costs on
right?
energy production. That's the theme there, right?
That's right. And I'd say in that same kind of aspect, I'd say anything around reliability services. So think, resiliency is something that we talk about on the power side, but there's other reliable there's other reliability that's required for anything to actually function and work, whether it's a data center or whether it's a new CCGT plant that hopefully will be built inside 3 years. It won't. So things that keep turbines running, keep substations running, keep pipelines humming. A lot of that, there's stress on existing infrastructure. Everyone knows that. I think it's less obvious than it could be. It's a fun place to play, and it's underappreciated, I think, by the investment community today.
Yeah, I mean the flexibility. I think the reliability piece is important. I think because it's the counter to this argument around we need to create flexibility in the grid. So there's been a few of these things that have come out where Google's working on flexibility and Slack on data centers and things like that. I mean, it's like if you sort of sit back and you think about this, it's like these companies are spending billions of dollars on research and then tens of billions of dollars on a research on a training cluster. There is no opportunity for downtime. There is no interest in like, why would you ever be interested in saying, oh, the grid's at a little bit of peak, so why don't we turn down our training cluster right now for the next couple of days? No one is thinking that. No one is interested in thinking about that, right? Like they're making a giant CapEx bet to the tune of 20, $30 billion on every training run. There's no interest in trying to, like, this grid flexibility concept, I think has to probably focus on grid reliability. Like, I'm not sure the Slack is going to be interesting because the workload here is just so important. And so I know there's this view around like, oh, well, we don't want to be running diesel generators on backup and this and that. It's like, you're going to run them for those 2 hours if you're going to have to keep that training cluster around during peak summer or peak winter because you have no other choice. Like, that is good. That's a good thing for the grid. It's a good thing for these companies that are effectively at this point the backbone of U.S. GDP growth. Like, I think there is too much focus on the flexibility side, and there actually needs to be more on the reliability side.
It's both, and I think the obviously the microgrid format that's been around for a while, but that's really I think now you are realizing that is really the only solution. So ultimately, a lot of the build outs are going to be using grid as actually the resiliency component. And the second piece, which I think is an interesting one for your viewers probably as well, is you will need all sources of energy possible, right? So we went from 2 years ago, I only want green. That's the only thing I'm going to touch. To I need everything as soon as possible, for a long time. And to y'all's point, reliable, right? And so that's sort of the second component. I do think there is an interesting component that's actually also starting to come out is again the scale of the build out. It's slightly also changing strategies of some of the companies. So one is obviously they're going to be very large businesses in the power space, but also they are going to be slightly different from a strategy perspective. We always say, are you the Schlumberger or are you the Kinder Morgan? And the way you structure contracts will ultimately depend will change your trajectory forever, right? It's not easy to do that. So I do think we're at this interesting time where you can do that with some of the companies if you're entering this next stage of growth. So but a critical piece, and we've looked at hundreds of companies, and I would for our lean team I would challenge anybody to say they've looked at more than we have. The critical piece is that operational involvement, right? We are seeing a lot of issues with again, how does a commercial contract look like? How should it be structured? What's the pricing? What's the timeline? How should I finance it? And just there's very basic things that we from oil and gas take granted that are not existent in a lot of the facets of that power services, power, infrastructure space. So operational involvement is critical. You as an investor are an extension of the management team.
I mean, that makes a ton of sense. I mean, look, when we talk about this kind of latest run, let's say, the AI view, and some people might think, okay, we might be in a little bit of that bubble. If you sort of think back to the businesses you guys were looking at when you first started entering this arena, there have been a lot. There's a lot of dead bodies there thematically across a lot of those industries. Do you think there are any lessons that we ought to apply thinking about the future state coming from that, right? And we don't have to name any specific companies specifically, but I'm sure you talked to a lot of them that were high flying, incredibly high valuation, completely worthless today, if not already dead.
Yeah, listen, it's there's a lot of lessons. It's easier to have lessons from the past because you had the benefit of time, obviously. But to Andrejka's point, we've looked at so many, right? Definitely somewhere in the hundreds across energy transition specifically, right? The first kind of couple of years of our platform, and then more recently, broader around infrastructure, adjacent services. But we passed on a lot, clearly. But the deals that we avoided, I'd say generally confirmed our thesis in hindsight. There's clearly been a graveyard of bankruptcies, whether it's failed private companies, failed de-SPACs, right? Hype cycles, all of that jazz. I think that the takeaway that's probably the most obvious to me now is unit economics need to work without subsidies. Like hands down, if you're raising capital or want to be in a place where you're generating alpha in a reasonable time period, right? You're not thinking about Japan 2050 or that style of kind of top down vision. I think hot spaces that are generally fueled by new monies, whether it's new money because of regulation, right, or new money because of subsidies, are not always going to be the best businesses long term.
The durability may not be there, right?
Obvious examples: EV charging. Obvious example: autonomous driving. Obvious example: within batteries, a lot of battery storage technologies, right? I'm not just saying super large ones that went bankrupt, but there were so many earlier stage battery companies that were raising capital from energy PE firms because they thought it was their way to get into energy transition. And it's not a great marriage. So I think that subsidy angle is huge, and the IRA going effectively being taxed in many ways, right? Whether it's buying an EV car, whether it's putting solar on your rooftop, whether it's getting ITCs for wind projects onshore or offshore, a lot of that changed fundamentally the underwriting of what would have looked very different, right? Had you been doing a deal in 2022, exit in 2027, well, it turns out that the time that you're exiting, it's a whole different
of course, a lot of capital. It's not that a lot of those markets ought not to exist. It's that there were too many players that raised too much capital and deployed it, at a pace that the market demanded, but the market demanded a pace that was probably not the right pace, right? Like there will be a few cockroaches within each of these that will survive to the next cycle, and they'll probably do very, very well, perhaps through restructuring or something like that, or maybe not. But if you have a velocity of capital going into a market that's completely subsidized, there's a huge risk of exploding.
I would add to Nader's. I obviously I may say things that are controversial and some folks will not agree with, but I will say it anyways because we fundamentally believe it at Dynamix. So subsidies, as Nader mentioned, that's a no-brainer. I grew up in a communist country. I know firsthand that kind of stuff just doesn't work, right? So that's why I'm here, and that's why America is the greatest country in the world, because it is the ultimate capitalist breeding ground. But there were some other and the second piece I would say where we also I think are differentiated is we see energy as one energy, and that always was the case, right? Since we come from oil and gas, I've looked at renewables in 7-8 sort of time frame at Mubadala, right? I was based in the Middle East for doing large projects. The renewable space have been here forever. My dad, who is 70, is like, oh, hydrogen, yeah, that's been around for the past 70 years, as long as I've been here. He's a car mechanic. These concepts are not new. Renewable has been kind of up and down. Ultimately, the way we look at the energy value chain is you are going to come to a point, probably, I don't know if it's the next 100 years or 200 years or 20 years, but ultimately, renewables will probably, the pricing will come down, right, with new and innovation and adaptation, yada, yada, yada. And at the same time, fossil fuels will price itself out, right? It's just not, we are not going to likely have some revolution where we're going to have some regulation, fossil fuels bad or renewables bad or whatever. It's an evolutionary process, just like it happened with, with wood and coal and whatever. Just look at energy as a value chain that's on a continuum and don't put it into different buckets. That's number one. And again, like where I think we are a little controversial, we just fundamentally believe that oil and gas will price itself out. That's how what's going to happen, right? And the second piece is, I do think when you mentioned, about the dead bodies and what happened in some of the sub industries in energy over the past few years, the a couple of components that were actually structurally, I think, not fruitful were minority investments. We fundamentally believe that a lot of the companies have a lot of learning to do. Those are capital heavy industries that will continue to need to raise capital, whether you are services or whether you are infrastructure. So actually, having controlling stakes and having somebody that you can point to, having Nader that you can throw under the bus as an LP or as a management team and say, Nader, you had control, you blew it. That control comes with great amount of responsibility. And so, but we do think that in this industry, you really need control stakes to again drive operational involvement and taking these companies, as teenagers to the next level. So that was the flaw in the last wave. You had a ton of minority stakes, didn't work. The second piece where, we have strong opinions about is so many times, Raj, 98% of our conversations in the sort of last wave of energy companies, mostly in the renewable arena was, hey, you have two options in life. You're going to have to raise probably $1 billion to get to a cash flow, right? So option one, you can say, I don't want to give up control. And all you're going to be for the next decade of your life is to be, you are going to continue having control for a period of time, because at the quantum, at scale that you need, you will ultimately have to give up that control. So your choice is, do I want to take a bigger slug of capital and maybe having, a Dynamix team being a little painful along the way because they're going to be more in my business, they're going to control my business. But ultimately, at the end of the day, I am going to focus my efforts on building my business and not continuously raising capital. Or you can, try to retain your control for the next 5 years. And really, how much do you have to show for it at the end of the day, because you spend time fundraising and not actually building business. So that concept of actually explaining to management teams, if you give up control, we are aligned. I want to make money. You want to make money. I need to exit in the next 3 to 5 years. You are going to make money alongside with me. That was a concept that was very hard to grasp. And fast forward from 2021 to today, it's a lot of blood on the street. And guess what? These folks are coming back, and control is the last thing that they are worried about, right?
And what's interesting too is a lot of the consolidators, right? The guys that have unfortunately gone under, if you look at who's acquired them, it's generally folks that were backed by large controlling investors, which is an interesting phenomenon, right? And you see that a lot in the microgrid space, specifically energy storage. But a lot of the guys that went under had, series A, B, C, D, E, and, super differentiated board, but every board member was representing a slug of capital that had a different fund cycle and had a different, investment horizon, right? Whether they wanted to exit in 3 years or 8 years, or just have a mark to market versus a cash exit. And there's so many differing principles there that clearly caused inaction, right? That's probably the best word to use. And if you think about it, a lot of, make up your energy, your management team kind of back end waterfall. There's two ways to go about it, right? You go get capital from energy private equity fund A, right? And they're going to give you a back end. They're going to say, hey, we're going to control you. This is how much you're going to get as long as you deliver capital in excess of XYZ. Or you control your own destiny and you go raise seed capital, and you spend 6 months the following year raising kind of your Series A, and the next 6 months kind of raising your Series B. If you do the math on a successful kind of fully funded business cycle that is capital intensive, this doesn't apply to software, but a capital intensive business, you're going to end up with 20% anyway, probably. And you went through 5 years of 6 months, 30 months of wasted time fundraising and bringing in kind of a diversified board of investors that maybe you didn't know otherwise, versus you could just execute a business plan and just raise from one capital source, gave up control, and end up with the same amount of ownership.
Yeah, but no one does that, right? Like you have founder-friendly capital, you got a bunch of VCs sort of like hyping you up, rate. What number do you want the valuation? We'll just put that in, and so you have a series of that. You could make the argument, like maybe they should have taken the private equity investor since day one. Perhaps they'd be more successful. But for private equity LPs, isn't this actually better? Like the reality is now these companies die. You get to consolidate a handful of them. You do have operational control now, so you can install management team members that are probably a lot more aligned and interested in generating cash flow versus just marking up valuation and raising more money and diluting out ownership. Perhaps this ends up being better for those LPs longer term anyway.
I actually think that there was an opportunity lost in the last administration with IRA, all the DOE support that the sector had, where you could have used that time frame with the right style of capital to actually build those businesses out. So I do think that one of the problems with renewables is, you mentioned that, Raj, right? Like there's this boom and bust, and so a lot of the companies, first of all, a lot of them are used to living on the edge, which it's different from oil and gas, I think, where there's more higher level of maturity, I think. But second is like they get this enormous amount of capital for 6 months every 5 years, right? And that destroys a ton of capital, and they were back to square one. We actually think it would be a much more productive way to push some of the areas of energy farther if you have the right style of capital and the right style of governance and the right style of involvement with these companies, and use the opportunity to bring these businesses to the next level versus great outcome, destroy again, great outcome, destroy. That doesn't really lend itself for a sustainable growth.
Yeah, the value proposition there was like quite tough, right? And which is why I think most traditional private equity kind of shied away. But most traditional private equity on the energy side, I think contemplated, they definitely contemplated backing several teams for various strategies to do what you talked about, back and build for that category. And I think even the people they wanted to back came to the conclusion that's like, hey, this is probably not a good use of time. Like, I don't think this is compelling economics. We're competing against people who are not playing the same economic game, right? They're willing to overpay. They're willing to sort of lose money. Losing money in tech margin where you have an ability to scale with zero marginal costs is very different than we're going to go drill 10 uneconomic geothermal wells or something like that. Like that is a very fundamentally different business model than I'm going to lose money on users for a couple of years and then we'll make money on all the users going forward forever. This is a very different bet, and for whatever reason, there was just so much capital that flooded on one side of the equation that went into this sort of capital intensive side.
I had this discussion with several investors, and one of the interesting phenomenons was also, I think that some investors had the opportunity to ask for control. I literally had a conversation with somebody, and they said, well, we're not going to get control. And I'm like, well, have you asked? Don't be afraid to ask. If you have $1 billion fund or certainly multi-billion dollar fund backing you should go ask for that control. You may be surprised. You may actually get it. And so I think that's another learning component from this last bloodshed that we saw in the renewable space. Next time, ask for that control. If you don't ask, you don't get.
Yeah, it's a competitive process too, right? Like they're competing against all kinds of random. Here's the new post-money valuation. Here's the capital coming in, and it was a tough time because everyone chased the same stuff, and there was a winner's curse to the people who won, right? Like now in hindsight, it's very, very easy to look back and say, okay.
Totally.
The other concept, that we saw as interesting, and again, we had hundreds of discussions like this, was a concept of explaining to some of the folks where the company should be valued at 50 million, but they actually got valuation of $1 billion, saying you are not a software business where you can afford this, right? It's a whole different concept. If you are a business that needs to continue to raise capital and you value your company at $1 billion in your next B round, no private equity in the world that's a high quality, responsible investor will look at your last valuation and base their valuation on the last valuation. That is a very different concept, right? It works again in the tech space, and it worked wonders. So it's not like a concept that I'm, slashing here, not at all. But if you need to continue to raise capital for your business, you are better off valuing your company at where it should be valued, so that the next round you can invite more investors to contribute capital to grow your business.
Yeah, agreed. I mean, for whatever reason, people were able to raise founder-friendly capital into a business that, is way too capital intensive. It looks very eerily similar to oil and gas. It ought to have been raised on a traditional oil and gas private equity deal. But, if you're a founder, why would you take that money when you're getting inbounds for people that are marking you up? And maybe you can do secondary, you can do this and that. And so in many ways, I think everyone did what they were incentivized to do, including those tech investors or like what venture capitalists. I think the problem is, unfortunately, that torched a lot of capital and probably a lot of good opportunity and potential on the development side of those businesses. And you took a lot of really smart people, and they worked on a pretty interesting mission, and they're just not going to get there. A lot of that's just a function of the capital markets.
I'd like to say one last thing on this topic, Raj. I mean, again, we saw this, obviously, this value destruction, even of companies that, could have been built into high quality businesses with the renewable arena. And we've seen a number of times, obviously, in renewables, but the last one in kind of the 2021, 22 timeframe. Let's take those lessons learned, and let's make sure we don't commit the same errors in the industries that we are investing in to power and service the AI growth. Let's make sure we think about it, because there's a lot of translatable lessons learned from renewables that should be translated now into these industries.
Yeah, or you just subscribe to the history repeats itself. Investors have a short-term memory loss. So that's been the world that we have lived in the last 5 decades. But yeah,
my suspicion is it'll happen again, right? Like it'll happen again. And so now the key is like, how do you avoid falling into that trap? How do you invest on the edges where there's an opportunity where the risk reward works for your capital? And you guys have opportunistic capital. You have obviously great flexibility in what you guys can invest in. I always think of like an asset manager is a two-sided marketplace, right? You get capital from investors for things that they want to invest in, and then you attract really good either founders that you want to back or companies that need capital. And you guys have done that. You just did one in a very interesting arena, and we'll see what happens next. All right, this one's
exciting
been great.
Times.
Yeah, absolutely. Is there anything? So if anyone wants to get in touch with you, knowing that add themselves to the roster of people who want to work with you, or people who want to try to get your thoughts on how to improve their business, you guys are more operationally involved. What's the best way to get in front of you?
LinkedIn. We're both on LinkedIn. Feel free to reach out, and we are excited about the opportunities ahead. We have an awesome team. We work together, we suffered together, and looking forward to the next phase of our growth.
That's awesome. That's awesome, Raj. Thanks for having us.
Appreciate you guys coming on. I'm sure we'll have something to talk about, whatever, 18 months from now or whatever. Maybe we'll make it even shorter, and we'll take a look at the world then.
Thank you.
Awesome.
All right.
Thanks,
guys.